Hi CA students, let's revise CA Final AFM Chapter 13 Business Valuation. Illustration 2. A Limited made a gross profit of 10 lakh and incurred indirect expenses of 4 lakh. The number of issued equity shares is 1 lakh. The company has a debt of 3 lakhs and surplus funds to the tune of 5 lakh. The market related details are as follows. The risk-free return is given, market rate of return is given, and beta of the company is given. The the requirements of the question are per share earnings value of the company, then equity value of the company if applicable EBITDA multiple is 5. Okay, now the first one is per share earnings value of the company. Now earnings value of the company is nothing but the EBITDA divided by the capitalization rate. So what is that EBITDA divided by capitalization rate? So that will give us the value of the firm, nothing but the earnings value of the firm. It's like a simple formula wherein we'll do this return percentage equal to return by investment. Now what is this? This is normal return percentage, how much percentage we earned income, right? So this investment is the base for this return. So using this investment we earned this much. Same way applying in the case of, instead of this investment, what if we keep the value of business, let's say business valuation or value of the firm. So let's say the value of the firm is 5 lakh and it is giving me a 10% return. So 50,000 will be the return. Now that's how we'll calculate return, right? What if we know this percentage? So this percentage is nothing but the capitalization rate. So then value of firm equal to return divided by the capitalization rate. So that will give us the value of firm, right? So in our case, return will be nothing but the EBITDA, earnings before interest, tax, depreciation and amortization. So that's what that is what the method we are going to use for per share earnings value of the company. So per share, in the sense, we will first find out the earnings value of the company, then divided by the number of share number of equity shares there. So we know now the gross profit of the company, so which is nothing but 10 lakh, and then there are some indirect expenses also amounting to 4 lakh. So reducing that, the EBITDA will be 600. Okay, and we know that the 11. Okay, we need now we know the EBITDA, which is the written portion. We need the capitalization rate. So capitalization rate can be found out using CAPM model, as we have a risk-free rate and then market return also, and then beta also given. Using that, if we found out 11.25% will be the capitalization rate. Now if we divide that this 11.25%, so 600 divided by 11.25 will give us the earnings value of the company, nothing but 5,33,333 or 53 lakh 53 lakh 33,000 and 330. Now the number of shares in our case is around 1 lakh. So that 53 lakh divided by 1 lakh will give us the earnings per share, which is nothing but 53.33. The second requirement is equity value of the company if applicable EBITDA multiple is 5. So EBITDA multiple in the previous problem also we have seen can be used to find out the enterprise value, nothing but the value of firm. So we know the EBITDA is around 600. So 600 multiplied by 5 will give us the capitalized value or the enterprise value, 3000 in our case. And we need equity value of company, so all the other portion, debt and all, we have to remove. So we know that the debt is 3 lakh, and then the surplus fund, which is cash balance, is 5 lakh. So that too, if we debt portion, if we reduce 3 lakh, and then if we add the surplus funds. Why we add the surplus funds? Because this surplus funds are for the equity shareholders only, right? So hence, since we need equity value, we'll be adding that back to the capitalized value. So 3000 minus 300 plus 500 surplus funds, which are available for the shareholders itself, equity shareholders. So 500 added back, the equity value is 3200. That's it. Thank you.